30 years from now, someone is going to drag up a price chart of silver, pause at a vertical line, and say one of two things. That spike, that was the $100 window, and I used it. Or, that spike, yeah, I watched it on my phone and did nothing. Right now, something very strange is happening. Silver is grinding higher in spite of every attempt to cool it off. Physical inventories are thinner than they've been in decades. And in more than one country, banks have quietly stepped back from selling physical silver at all. Not because they don't like the metal, but because they can't reliably get it in size. Think about that. The institutions with the deepest pockets and the best connections are the ones quietly putting up the no physical available sign. Meanwhile, the person with a modest paycheck and a local dealer down the street can still walk in, put cash on the counter, and walk out with real ounces. That is not normal. That is not just another day in commodities. That's what it looks like when a window is open and closing at the same time. This video is called "The $100 Silver Window is Closing Fast with Banks Locked Out of Physical Sales." By the end, you'll understand three things. The four-stage pattern that always sits behind these impossible moves. Why banks stepping away from physical is the loudest warning siren you will never see on TV. How a calm, boring, physical-only plan lets you use this window without playing the bank's leverage game. This is not personal financial advice. This is pattern recognition. Let me show you the pattern. The four-stage pattern they never teach in finance class. Every time a monetary metal explodes, the story on the surface is different. Sometimes it's inflation. Sometimes it's war. Sometimes it's a currency crisis in slow motion. Underneath, the script is always the same. Stage 1, establishment. A commodity becomes money. Governments peg their currencies to it. Coins are literally made out of it. People trust it instinctively. For silver, that was the era when U.S. coins were 90% silver. You could walk into a bank with a paper dollar and walk out with real metal at face value. No one thought about trading silver charts. It was just part of the monetary plumbing. Stable, boring, invisible. Stage 2, manipulation. Then someone realizes something. If there's 10 ounces in a vault, why not write 20 receipts? Or 50? Or 100? Why not create? Futures contracts, ETFs, certificates, unallocated accounts. Each one is a claim on those ounces. The vault doesn't change. The claims multiply. Paper is cheap to manufacture. Physical is hard to dig out of the ground. So the system floods the market with promises. On screens, it looks like there's endless supply. Prices drift down or stay suspiciously tame for years. Everyone gets used to the idea that this metal is dead money. That's stage 2. Stage 3, the squeeze. Then, slowly at first, something shifts. Industrial users start worrying about secure supply, not just price. Investors who read history stop trusting exposure and start asking for delivery. Central banks in nervous countries quietly buy real bars instead of paper claims. Vault inventories that used to be fat cushions start to thin out. At first, nobody cares. Then dealers start quoting higher premiums. Then you get days where spot trades above futures, backwardation, because people will pay more to have metal now than to trust a promise later. At some point, you hit a line in the sand. There simply isn't enough easy metal left to satisfy everyone who wants to turn their ticket into metal. That's where we are headed, and in many respects, that's where silver already is. Stage 4, the break. Stage 4 is where the game stops being theoretical. Trading halts appear out of nowhere. Contracts that used to be deliverable suddenly get a cash settlement-only footnote. New rules appear mid-game. Position limits, margin hikes, liquidation only. The people who thought they owned metal discover they owned a claim in a queue. The people who own coins and bars in their own custody watch the chaos from the outside. These 4 stages aren't a theory. We've watched them play out painfully before. Let me show you the most dramatic silver example first. The day silver nearly broke the system and why it matters now. Late 1970 seconds. Inflation is raging. The dollar is wobbling. The U.S. has just cut its last formal ties between gold and currency. 2 Texas oil billionaires, Nelson Bunker Hunt and William Herbert Hunt, look at the world and draw a conclusion. If paper dies, real money wins. Gold is hard to get. Silver is cheap. Let's buy silver. They don't buy a little. They quietly accumulate somewhere in the neighborhood of 200 million ounces. Half of it in physical form. Bars, coins, bullion. The other half through futures contracts, which are paper claims on future delivery. In 1979, silver is around $6. By late that year, it's over $10. By early 1980, it spikes near $50. The hunts look like geniuses. The press paints them as villains. Wall Street is terrified. But here's what really matters. They aren't just speculating on price. They're asking for delivery. Every contract they force into delivery is another chunk of silver yanked out of the available pool. The exchange starts to panic. If the hunts keep demanding metal, the paper market might snap. So the exchange does what exchanges do when the wrong side is winning. It changes the rules. New margin requirements. New position limits. Liquidation-only directives where you can sell contracts but not buy more. The hunts get margin called. They scramble. Others panic. Selling cascades. On a brutal day known as Silver Thursday, the price collapses. The hunts lose over $1 billion. They go from the richest to nearly ruined. That's the story everyone knows. Here's the part most people forget. The quiet people who bought physical silver at $4, $5, $6, and didn't use leverage, never got a margin call. When the dust settled, silver wasn't back at $1.50. It eventually stabilized many times higher than its 1,970 seconds base. They didn't need the exchange's permission to keep their bars. They didn't have a broker forcing them to sell. They just owned the metal. The hunts were right about the big idea. Paper is fragile, metal is real. They were wrong about the method. They parked their bet inside the system they were betting against. That's the first lesson you need to understand before you even think about a $100 silver window. Other cracks in the same glass. Silver 1,980 isn't the only time we've watched this movie. 1,971, the gold window. Foreign central banks used to be able to trade dollars for US, gold at a fixed rate. Then they started actually doing it, in size. It turned out there wasn't enough gold to honor every claim, so the US shut the window. The promise broke. The paper system changed overnight. Gold, freed from its peg, launched into a multi-year repricing. The paper promise failed first. The metal held its value through the chaos. Early 2000s. Palladium. Palladium wasn't on most investors' radar, but automakers needed it for catalytic converters. Russia controlled a massive chunk of supply. Then shipments slowed, rumors flew, industrial users panicked, bid up spot, and scrambled for secure physical. Prices spiked multiple times from their base over a short window. Futures traders who thought they could just roll were suddenly staring at physical delivery they couldn't meet and contracts they couldn't unwind without pain. Again, paper markets shook. Physical owners who already held the metal had options. Different metal, different decade. Same four-stage pattern in the background. Establishment, manipulation, squeeze, break. So when we talk about today's silver market, we're not guessing. We're comparing the current picture to these earlier scripts and asking where we are in the sequence. Where we are now, the squeeze with a countdown clock. Let's pull the camera back to silver. Stage 1, establishment, is already in the history books. For more than a century, silver was official money. That era ended when governments stripped it out of coins and backing. Stage 2, manipulation, is also done. We live in a world of silver futures contracts that trade in volumes far beyond annual mine supply. Silver ETFs and structured products that promise exposure but can be settled in cash instead of metal. Unallocated accounts at banks where you own silver, but not in the sense that you can walk in and demand a specific bar. The number of claims on each ounce is gigantic. That's not a conspiracy theory, it's just how the system was built. That leaves stage 3, the squeeze, the part we are living through. What does a squeeze actually look like from the inside? It doesn't look like zero inventories. It doesn't look like empty charts. It looks like friction everywhere. Industrial demand rising relentlessly because silver is woven into the modern economy. Solar panels, electronics, EVs, medical gear, communications, defense, mine supply struggling to keep up at current prices because silver is often a byproduct of other metals, not a primary target. Years where total demand quietly, consistently exceeds total supply, forcing the market to eat into above-ground stockpiles. Vault inventories trending lower, especially the portion actually registered and available for delivery. Dealers offering less variety, longer wait times, and higher premiums over spot. And most telling of all, banks and large institutions quietly stepping back from physical sales. That last point matters more than people realize. When a small retail investor can't get metal, the story is no demand, nobody cares. When a giant bank can't get metal, that's different. Banks have direct lines to wholesale markets, deep relationships with refiners and mints, the ability to hedge and pre-order. If they still decide to halt physical sales, it's rarely because they hate silver. It's because they can't secure enough product without unacceptable risk, or the volatility and low inventories make the risk-reward of being a middleman miserable. In other words, the people with the best access are being forced to behave as if the shelf is already half empty. And yet somehow, a motivated individual can still call 3 local dealers, check a couple of reputable online shops, and actually get coins and bars in hand. That gap between institutionally locked out and individuals still able is the window. It won't stay open forever. Why banks being locked out is your warning, not your doom. There's a dangerous way to interpret banks locked out of physical sales and a useful way. The dangerous way is to hear it as, if the big players can't get metal, then I'm doomed. I'm too late. There's no point trying. That's how you talk yourself into freezing just when action matters most. The useful way to hear it is like this. If the big players are struggling to get metal at scale, but I, as a small player, can still get a few $1,000s worth, then I am living in a rapidly closing window where my size is an advantage. Big players need millions of ounces. You might need a few hundred. They need continuous supply. You need a few good decisions over a couple of months. For them, the shelves are already empty. For you, they're thin, but not yet bare. That is exactly what stage 3 looks like. The system cannot clear all its promises smoothly anymore. The friction shows up first at the edges. Certain products, certain regions, certain banks. The average person still has just enough access left to move. When that changes, when dealers have more out-of-stock labels than prices, delivery times are quoted in months instead of days, central banks openly admit they're stockpiling because they can't trust paper promises, then you'll be on the doorstep of stage 4. By the time the nightly news uses the phrase silver shortage, the cheap part of the $100 window will already be gone.